Welcome to the Dividend Talk podcast, episode number 9, How We Do Fundamental Analysis. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and as usual, I'm joined here today with European EDGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to the channel, please hit the like button and subscribe to us, and also check out our previous episodes on YouTube and Spotify, and any other podcast platform that you're on. See you on the inside. Hey guys, welcome back to another episode. Today we're just going to have a little chat about how we do fundamental analysis. I think we touched on this a little bit in episode 5, where EDGI shared his G sheets, which has a list of steps on how to do fundamental analysis, and it's something that I've used in my recent blog posts, and it went down pretty well. So we thought we'd just run through it a little bit and just show you guys how we do it and how you may be able to use it in your own analysis. But before we get into that, we'll just have a little chat between ourselves. EDGI, how are you getting on? Haven't talked to you all week. I know we've been both busy.
Yeah, it was extremely busy at work, so the vacation is going well, let's say. But how to say, I feel a bit like crying because my favorite team just got beaten up by 8-2. And I know I've got quite some followers from Spain on Twitter. And guys, I hear you. I feel you. We'll get them back next year. Even if you're from Real Madrid, I'm sure you support that Bayern should have lost and not Barcelona won. And that's also my news from the week, because I can't remember the last time that Barcelona got beaten up with 8-2. And, this is a semi-final of the Champions League, right? And it was deserved. It was not even like 1-0, 1-1, and then they 2-2, and then suddenly something happened. 3 people suspended. No, this was 11-11. Oh my God! I don't even know how I will fall asleep tonight, because
it was an incredible game. I watched the first half and most of the second. I missed actually the last 3 goals. Coutinho, a former Red, got 2 of those, but I mean, the first half was just a masterclass, and it's not as if Barcelona weren't trying, and they just took Messi out of the game, and they just battered him. And the typical German style, no mercy, just go for the jugular. But
yes.
But I'm opposite. I was kind of rooting for Munich. I think they've been really good this year. I'm hoping they'll do well. I'm sorry if there's any Man City fans out there, but I really hope that Munich go all the way now. They're one of my favorite teams. I was kind of sad. I was in Munich last year, and I had it was actually the week they were playing Liverpool, and I had tickets to go see him. And in true Irish style, I went drinking instead, and so so I missed out on that opportunity. But it was a great game, and look, they deserved to win 8-2. It's incredible.
I think I don't even know how the coach of Barcelona is called anymore, because I wasn't so much paying attention this season due to Corona.
But he's sacked.
He's out. And I did some, by the way, it's probably people on Money Twitter will probably tell me that I am having the worst mindset, but I was doing some sports betting in the past. And I would just I told myself once a year I submit 50 euros to, I don't know anymore, was it Bet 23 or something like that?
Yeah.
And then I would every time put one euro into betting. And I mean, guys, if there are some sport bettors among you there, if any one of you put 8-2 there, then I mean, what shall we do then, EMF? I mean they get 45 minutes airtime in this podcast. Just they can say whatever crap they want, right?
They can have as long as they want. If they predict 8-2, they can have as long as they want. But just to go off on a little bit of a tangent, and we'll pull back into our normal dividend talk. You can actually make quite a bit of money sports betting in a non-risk fashion, and I don't know if you heard of it, but it's match betting. And Betfair makes it possible, and it's something I've done in the past. I made quite a lot of money. Actually, we paid for our wedding out of the money I've made from match betting. So anyone that's in the UK or Ireland, I'm not too sure on mainland Europe, but certainly UK and Ireland, contact me and I will set you on the right path and how to do it. You could make, in the first month, you can make, someone that's new could easily make €1,000. It's risk free. You can't lose. But that's going off in the tangent.
That's cool. So will it also pay for a divorce?
Your money might be gone by that stage.
Hey, what's your news of the week, EMF?
I mean, after that, mine's just going to sound depressing, so I just want to kind of skip over it. But I suppose the only thing that jumped out at me this week, and I shared it on Twitter, was that recession. UK is in recession. It was printed all over newspapers. I've known that Ireland has technically been in a recession and Europe has been in a recession for a little bit now, but it's not really out there. You'd have to go looking for it. So it was interesting that it just popped up in all the kind of major news outlets, RTE and stuff over here, that they are in a recession. But when I was kind of looking at the numbers, Spain's GDP was the worst, -22, and then the UK was next. Yeah, France, Italy, Germany, then the US was down, but the US was down as -10.6. The huge numbers at the moment.
Yeah.
And it's just kind of scary when I'm looking at the stock market and we're seeing all-time highs and it's a V-shaped recovery and the stocks gaining nearly 10% a day at some times, and just total disconnect. And that kind of had me mind in a bit of a frizzle there. Oh my God, are we going to crash? What are we seeing? But I suppose that's what happens when you read too many newspapers, isn't it? You kind of get yourself down a rabbit hole. But it was just really interesting to see that it's now out there on the national newspaper. So I'm wondering how, especially the UK market, the FTSE, how that's going to react now. Will that start to tumble, and will we see? But look, it's not nice news. Nobody likes recessions, but we can't deny that we are in one.
No. So Burswolf had a nice tweet about that, actually, that it's no surprise that the stock markets are going to all-time high because of all the cash that's available. Yeah. And a Sunday investor, I think, he responded on that he's working on something for his newsletter. So I will be trying to get hands on that newsletter. I'm very curious to what he has to say there.
I've signed up to his newsletters and I find them great. Yeah. But I think low discount rates have a lot to do with it as well. There's many different factors, but I suppose, who knows?
It's surreal.
Who knows? We're in certainly in a difficult time. Yeah. But hey, that, as I said, a little bit more depressing than the football match, but that's the reality of where we are at the moment.
Depending on whose side you are. Okay. Let's look at the template. So if you're on Spotify listening this or Apple Podcast, we'll try to speak in such a way that you can follow it. We'll share the link also again to the template. The template that we're using is really about fundamental analysis for dividends, for stocks in general, but then with a little bit of a flavor of dividend stock analysis in there. And we mentioned before in episode 5 that it's based on the book, The Single Best Investment. At least that's where I got my inspiration from. Also on Jachtman's investment fund, on how they qualify, how they define a good business and what is for them shareholder-oriented management and such. So what I would suggest is that we go to several of the sections that exist there.
Yeah, so I think it's important to say that there's 6 main sections that we look at, and they all have different weightings. So you look at the financial strength first, which is obviously the most important section, you would imagine. So that has the highest points available, as 25. And then we filter down through, we look at the management, the dividend quality, the valuation. Then we look at the story of the stock, how you think the stock is going to perform in the future. And then there's a small section on trade analysis, momentum. So I suppose that one's the least relevant, and there's not much else to say on that. I think it's just an RSI ticker that we look at. Is it overbought? Is it undersold? And you give it a rating. But I think for most of our listeners, certainly the financial strength, the management quality is interesting to hear from you, for me. and dividend quality and valuations. They'd be the four that really may benefit our listeners a little bit more. So if you just want to start, actually, if you want to start on the management quality side, because I know you're really big into checking out the CEO and the management side, and just talk us through that little bit of a section and how you go about maybe researching the management and making the decision on that.
So first of all, I think that managers in a boardroom, especially CEO, has a lot to say, right? So effectively, as shareholders, we bet also on the CEO. Buffett has a great quote. He says, "If you have a good company, you can have any idiot at the helm." Unfortunately, I think this works for Berkshire probably, but we have seen the stories like General Electric. If you have an idiot at the helm, they can just damage the whole company. Yeah. So if there's too much ego, so that's why it's so important for me. So, but there are some things how you can measure it. So what's important for me is, for instance, ethical business, and I'm not talking here about ethical in the sense of is smoking ethical. So I'm not talking about sin stocks. I'm talking here about like if you're, for instance, a chemical company, yeah, are you having a lot of waste all the time? Are you losing your chemicals in the water and such? You could argue, well, hey, what does that matter for the business? It does matter because it probably means that they have a really sloppy warehousing, distribution, safety measures in place. So this company is already more at risk for, let's say, a deep horizon is what happened to BP.
Yeah.
So the violation tracker is for me really good. It also talks about fraud, and that's why I would never buy Wells Fargo. Yeah, I know that many people like Wells Fargo for the yield, but their management quality, and it was not even after replacing CEOs, they keep having issues. They still, I mean, I would expect if Wells Fargo would just say like, okay, guys, we get it. We made lots of mistakes. Yeah, we will, and really make a kitchen sink as a management. I think then, so hence why the violation tracker is for me a really important one, because these are facts. And what is nice in violation tracker, you can compare it with their industry competitors. So that's for me a good sign. But also what I'm looking at management quality is like, how did they perform during a recession? Because I think also it's easy to earn money in a bull market, but I think in a recession, you also really can easily see like, what is the business doing? Are they cutting costs and deteriorating their business model, or are they actually doubling down on it? And I think the past performance is here a good indicator. But I'm also looking at acquiring companies, and what this for means how do you know if a company was whether the acquisition was well? I look at the goodwill and I look at the impairments in the annual reports. And many write-offs are currently happening on past acquisitions, because now is the optimal opportunity to do it. But it just shows me, when I see so much goodwill on the balance sheet, I already wondered, oh, it's probably overpaid. And then if you then look at the cash flow, the free cash flow, you can actually see, okay, is there actually an uptick in the free cash flow going on? So these are for me all signs that the management is making the right decisions.
And it's interesting you mentioned integrity. There was something popped up on my Twitter feed there yesterday or the day before from Dividend Fund. I was quickly scrolling through trying to find it while you were chatting. But he had a list of top 10 companies to work for as per Glassdoor. And he had it in an ETF tracker. And it actually performed quite well. He had some brilliant companies in there, by the way. You had Johnson & Johnson, you had Intel, and some really good companies. But I think you can tell a lot by a company by how they treat their employees at grassroots level, so to speak.
Exactly.
And integrity. And one thing that disappointed me was my company that I work for wasn't there, and some of my competitors were. But no, I think it's really important, as you say, the CEO has a big part to play, and his integrity and how he treats his employees, that will project out and ripple through the whole company. So no, I think that is really important. And look, out of 100 points, you give it 15 points overall, and I think that's fair. It gives a good balance. A good balance of how management is doing compared to the overall structure of this template.
Yeah, you need to know that. Let's talk now about financial strength, right? I scored at 25 points, one fourth of all. I mean, poor management will lead to poor financial strength as well. So I think the hand of the management is all over the place there. So if we look at financial strength, I'm looking really about balance sheet metrics.
Yeah,
So, for instance, debt to equity, what's the ratio? This is sometimes a little bit tricky because if you look also, for instance, on return on equity as a metric, if a company did a lot of share buybacks, you might see actually that the retained earnings or something like that is, I don't know exactly anymore the accounting post in there, but you will see that suddenly these numbers are really squeezed because of share buybacks. So that's the only thing I would like to say, like, don't look purely at the rate. Sometimes if you see an awkward number, just check the balance sheet because you might see that the buybacks had a high impact there. So, but interest coverage, how easy is it for them to pay the interest with their free cash flow?
yeah,
I'm also looking at strong and stable cash flow growth. There are some companies, and I'm sorry, I forgot which one. I think FedEx. I've been looking into FedEx several times. It has really poor free cash flow performance, right? And that's why I will not buy that company, although it's really attractive for me every time because I want an e-commerce play as a dividend grower.
yeah.
But yeah, maybe you see also some of the other metrics there, EMF, like how is the
Yeah,
EPS growing? And
yeah, earnings. I think you have pretty much most of the things that you would need to make a good decision. So you're looking at the earnings over the last 10 and 5 years, payout ratio, both with earnings and free cash flow. As we know, payout ratio with earnings can be manipulated with accounting practice. So free cash flow is obviously there. And then you look at the credit rating. Morningstar, you can get it from there. You can also get it on Fastgraphs. And also, I don't know how you gather the information, and you can go through obviously financial statements, and that takes time. But I did come across a website recently called Macro Trends. I don't know if you've come across it before, and it has everything that you have here. It has on their site, and I've done it with Walgreens. My last post, I went through the last 10 years of annual statements, and I compared my data with their data, and it was spot on. So
nice.
I was quite happy. And then I went back over AOS and I checked 3 years and compared, and they were spot on. So I'm quite confident that they have pretty good data, which might quicken up the process for some people that
definitely
don't have the time. So that's called macrotrends.com actually, just in case you didn't get that.
Cool.
And then the next one is obviously the dividend quality, and I suppose we all know what we're looking for here.
Yeah, but it's an interesting one.
Yeah, the interesting one there for me was how long would it take to reach a yield on cost of 10%. And that was a very, very good one, because it's not something that I've thought about before until I've seen it here. So that is quite a good one to do. How does it compare against the S&P 500? I mean, you can automate some of these, and I have a lot of these automated through G Sheets. I can get the S&P 500 dividend yield and compare. I just have a little formula and I can fill in these. So it's definitely good. And then the dividend growth rate over the next 5 years and earning projections, it's all standard stuff, I suppose.
So about the how long it takes to get to yield on cost on 10%, there's one of our listeners, Phil. He also commented on the last YouTube video from us.
Yeah.
And he also commented on my blog on this, and he gave a really nice calculation on one of the stocks that I wrote a post about. And you know what it is with 10%? It is where the snowball starts rolling, where you really feel the impact of the dividends and the compounding effect. So that's why, I mean, 10%, you could argue, why not 9.8 or 10.2? So there's kind of a psychology in that number. But I just find it the same as what they say. You need to reach the first 100K before you really start to feel the impact of compounding in your dividend portfolio. For me, it's the same with the 10% yield on cost. Then you really feel like, okay, this is coming in big now.
Yeah. And look, if you follow me on Twitter, you know I like round numbers. So
Yeah.
why not 9.8? No way. 10 points all day long. Keep the round
Exactly.
numbers.
Okay, and then one other one, and I don't know if people are familiar with it, is the Chowder Rule. And the Chowder Rule, there's a nice Seeking Alpha post. He's also contributed to Seeking Alpha, but it looks at the dividend growth rate plus the dividend yield. And it's kind of, I don't know how you say that, but kind of rule of thumb calculation. I don't know what the English word for it is. Or a back on the napkin calculation. But it is kind of, if you know that you have 12 as a result, above 12, and I think this for the normal stocks, you know that you're having a good value play. And I think for utilities, it's probably 8 or 9%. But I really like this check always whether Chowder Rule is more than 12 or not, because it might be that you have, for instance, high yield but no growth, and then your stock, your compounding might actually not go anywhere really.
And where would you find that Chowder Rule for those that are not familiar with it?
I will link the post in the description.
Yeah.
And I will link the post to Seeking Alpha, and that's where it's all explained. I think the post is already 4 or 5 years old. You see this Chowder Rule. You see it also as a metric in the dividend champion list, the Excel sheet.
Yeah, that's what I would normally see, but I wasn't sure if you got it from someone else. So
Okay, and yeah,
the last section, I suppose, is the valuation, and it's something that I've started to look at a little bit more lately. I had a blog post I wrote it in Word, and I never saved it, and it's gone. So I have to redo it. I should have wrote it on GDocs. But it's as I said, it's not my strongest point. It's something that I'm starting to learn. I got a really cool multi-stage dividend discount model from the Sunday Investor, and he wrote a post on it as well. I've converted that into G sheets and try and automate some of the values. So I use that for my DDM model. I noticed you have stock analysis on net for the DCF valuation. Did they give you a value and you just plug in the figures, or is it a template?
Stock analysis on .net, you can actually find the whole discount cash flow calculation straight off. I think you can browse there up to 5 stocks or something like that, and then it puts a banner like it needs a subscription. But you can find the whole calculation there. So if you're in doubt, and I've several times checked their calculations, and they're pretty good, I must say, pretty accurate. So if you want to be lazy, I would just say, like, check it out there if this is a complex matter for you. You find it for almost all US stocks.
Yeah, I use incognito mode, so just log on and off, and you can easily exceed your five limit max.
Okay, cool. But there are some other topics in there. I look at insider selling as an example. Are insiders selling or are they buying? That's also for me in valuation actually quite. And I think I got this from this book that I referred to, right?
Yeah.
I don't look too much anymore at the PE, whether it's higher than 20 or not, because in the low interest rate environment, I think it's more shifting already towards 25 sometimes.
Yeah. I mean, my take on that is that I know you had in there as 20, but I have, is the PE higher than the industry average? So I kind of look at the industry as it is now and make a decision based on that. 20 is just, I suppose, it is a good foundation, but we're seeing stocks now that are 25, 26, 27 PE, but they still look undervalued. And so it's, I think if you take it by industry and by stocks, you'll get a feel for it yourself. I wouldn't just take 20 for all industries is I suppose my point here. You can have a little bit of flexibility in that. And then with things that you have in here, so what is the revenue growth of the last 5 years and what is projected? So where do you get these projections from? Do you get them from Morningstar or
the analysts' recommendations are there. You can quite find it there, and also the company itself usually gives a future estimate.
So I use Morningstar, and I think you can check on Morningstar as well. The analysts over the last 5 years or 10 years or some defined period of how they've predicted this company's over time, so you get a good feeling of.
So
whether
if
they're
you
right.
look at the scoring mechanism here, right, and the scoring is all a bit arbitrary, yeah. But you see also that I don't give too many points for these kinds of things, but these are signals. These are, let's say, indicators. They are not like KPIs for me or something, but just simple indicators, signals. And if you have too many of those signals negative, then they don't score points, but it adds up then over time. So, and that's why it's so important, and it gives a little bit more of an unbiased analysis.
Mm.
There's also behind the valuation, there's still another section which I find quite important, and that relates a little bit to the growth projections for revenue. It's a story of the stock. So I believe really, like Peter Lynch, if you cannot say in one or two sentences why you're buying a stock, then you should probably not buy it. So hence why there are some questions around the marketplace. So is the marketplace stable? And if you really want to, you could do a five Porter analysis here. Yeah, where I don't know if you know Michael Porter as such, but he's one of the gurus in let's say general management and competitive analysis.
Mm. We touched on them a little bit in, I think we had one business module in my engineering studies, and Michael Porter was top of that list, so I'm vaguely familiar with him.
So but it's really simple, right? You know that an airline industry has high entry barriers, or a car industry. So and if you're not familiar with the company so much because it doesn't even operate in your area, these are probably good things to just check a little bit. Like, is it easy? Is there any IP protection or not? These kinds of things are just important if it's related to the core business. But also like the future promises, and here I'm really looking for a catalyst. What is there really a next big product in their pipeline, or are they just trying to squeeze out the last drop out of their existing product line and there's nothing coming up, right?
Yeah. I mean, healthcare products would be an example there. I mean,
really easy.
Yeah, a really easy one. Yeah, we know they rely on their flagship product, but when that's coming to the end of its term and it's going to be released to the general public, and the patent runs out, what's their next?
I give you a perfect example where I'm struggling to see it. Hershey. It's a great chocolate manufacturer.
Yeah.
I have a feeling that their products are not anymore really in the health space, more in the unhealthy space. So they have Reese, as their favorite brand, as an example.
Yeah.
And but what you saw is that they were losing a little bit shelf place near the cashiers and such. And what was really their next new line of products that will really be a growth kicker again? I couldn't find it. They tried it with these drops. These looked a little bit like tears. A new product. I think it gave it a little bit of a kicker, but I think such a company is struggling, and you see that when you analyze it, when you go, okay, but what is really their growth kicker? Because how many? I mean, before I did stock analysis, I never thought about growth. I just looked at, okay, I have a screener, look at it, yield good, hey, buy.
Yeah.
But this growth kicker makes you, it brings it from a stock to a company, and then you come to Buffett's question, like, do you want to be really an owner of this company?
Yeah.
And that's what I try to answer with these kinds of questions.
Yeah, and look, we're dividend growth investors, and part of that dividend growing, you need earnings, you need revenue, you need all these things to grow. And if they don't have the products, and if they don't have the services coming up or in the future, then how can they grow their dividend? So it is really important to look. You can't predict the future, but if they at least they're showing some bit of something that they has the potential, then it's
and that's why IBM as well. Yeah. But we checked the other time in one of our earlier shows. Red Hat is such a little portion of their business. That on the short term it will probably not move the needle, but for the rest, it's only deteriorating at the moment. That's how it feels like. Okay. Anyway. I think so. And regarding the future promise is a little bit about this, and you can also look at their capital expenditures. Are they growing or not? For instance, you will see in the oil industry they're cutting heavily on that to boost up the cash flow. These are just good signals, all indicators, I would say.
Yeah. And look, that's pretty much the spreadsheet in a nutshell. I think we've covered it quite well. If any of our listeners have questions, feel free. we'll share the link again. EDGI was kind enough to share it in the first place. So, as I said, I personally use it. I find it great. If you're looking at fundamental analysis to help you, I highly recommend you get the spreadsheet. Ask us questions anytime, Twitter, email, YouTube, anywhere. Just ask us. We'd be happy to talk you through. I'll even jump on a call with you and talk you through. No problem. But I find it great, and it's really helped to my understanding of companies and really helped me in picking my own stocks as well. So thanks for sharing it. And as I said, download it if you can. So on to our next section. I think we had one question this week from one of our listeners. We had it from actually John on the Money Pursuit, who was on here a couple of weeks ago. And his question was, do you check how capital intensive a business is before investing? Or maybe you rather a specific gross net income margin before investing?
So let's say like that, we just went through the whole fundamental analysis and you didn't hear it really up there. I think there's somewhere something around gross margin, how it developed. So I'm more looking at trend.
Yeah.
It's capital intensive is not really important for me as such, because for instance, an airline industry is capital intensive, but I'm not investing in airlines industry, not because it's capital intensive, but because their earnings are so, I said, so cyclical, and they tend to cut dividends all the time. So for that reason, I don't really look into it. I would look into it if I think there are challengers. As an example, I don't own banks at all, but I have a little bit this issue at the moment with insurance companies. I own Munich RE. What I'm a bit afraid of is the fintech stocks. Yeah, and you could argue by that they are probably a little bit less capital intensive with higher margins because they can build a whole cloud model around it. So they probably need less sales force by using digital transformation, digital challenge and such channels. So yes, it plays a role, but not as prominent as how the question is. It's more like already covered in the other topics that I look at.
Yeah. I'm pretty much the same. It doesn't have a final decision in any of my decisions. As far as specific growth, net income margin, I mean, I do check, but it's not something. You're kind of just checking to make sure that there's nothing actually wrong or there's nothing that stands out. I don't have a specific goal in mind. I mean, for some companies that could be as low as 10% and it could be good. For other companies, it could be 30% and bad. So, I mean, you just got to take it on case basis. But it was a good question. Thanks very much for asking, John.
So then we have our favorite section of the week.
Our stock pick of the week.
Yeah, definitely.
So my one, and I've had this before, Cisco. I suppose the reason I went with Cisco again is yesterday they had a massive drop. I think about 10 or 11, 12% drop, which made them come back down to my value range. So I have them fairly valued at about 47, which is what they were kind of hovering around, and they took a drop then to 42. They released their earnings, and although they beat their earnings, their consensus for next year was below what was expected, and they've got hammered hard for this year. Actually, just before I came on, I got a notification on my YouTube. Physical Voyage did a video, should I buy Cisco, which I found kind of funny because I was just after writing in that they were my stock pick, and so I watched the video, and it's quite good. Recommend you pop over and watch it. He goes through the fast graphs and gives a nice explanation of their growth and where they're going, and he kind of wants to buy him, I think, under $40. I'm happy to buy him, around 42, 43. But as I said, I'm not too concerned about these in the future. They took a nice drop. I'm going to add some more shares at the current price, and we see how we go. But definitely check out that video and let me know what you think. So, who's your stock pick for the week?
So, I will take British American Tobacco again this week. I think it's still for me now a no-brainer. Still struggling. at home a little bit with the investment case. But I mean, the stock in price went even a little bit down since I wrote my post. I mean, £25 now. Let's say, give it or take it. And I really believe in this. I mean, they're like, and it's even the yield there. It just you could say, hey, but the yield is like 10%. When it reaches 10%, it's a red flag. They might get a dividend cut. I just cannot see a dividend cut upcoming if I look at their fundamentals. So for me, it's almost like, of course, this stock doesn't belong, I think, in anyone's dividend growth investment portfolio as the main core foundation stock. But if you're looking a little bit at your long tail of your portfolio, I find this stock actually really good. And hey, if you buy an 8.5% yielder, it maybe justifies for you also to buy like maybe a growth stock, like a tech stock at 1%. Why don't you mix it up with Microsoft? If British American Tobacco does it a little bit bad, heavily undervalued, maybe Microsoft does then the heavy lifting, and you get an average yield still of 4 to 5%. It's just how you can look at it, right?
It's funny you say that, and you might not believe me, but I could show you a screenshot. So last week I bought some British Tobacco, and based pretty much similar reason to you, I bought some Microsoft as well. And
No way.
Honestly, and I'll share some screenshots with you. I bought the two of them at the same time, and normally I wouldn't go for Microsoft because the yield was, I think it was, I got it at 1%. It's around 0.98, and usually that's a bit low. But when I was buying something at 8%, I was like, okay, I can still buy something a little bit lower. I am bullish on Microsoft. I would like to buy them at a lower price, but I did want them in my portfolio, so I did. I did actually buy the two of them at the same time. So it's just mad how you said that.
I need to talk to my mother. You might be the brother that I never had. I need to talk to my mother. This is creepy.
Just to note, we haven't discussed this, and I haven't said this to anyone, or like.
This is so creepy.
That was. But I mean, that's what I like about dividend growth investing. And even though we're worried about how the market is, well, I am a little bit worried, I suppose. There's still always value. You wrote a good post, 5 undervalued stocks, but there's always stocks out there, no matter what the conditions are, that you can pick up and buy that will be undervalued, which is one of the things that I like about this type of investing. So, yeah, no, I agree with you. The British Tobacco, it was actually your post helped me make a decision. I said they were on my checklist to do, and you made that real easy for me. But no, I'm still a bit blown away now that you said that. So I was like, man, I literally just did that last week.
Hey, well, we're now anyway in a cheerful mood then. Why don't we just plug straight away our event for next week that we want to do?
Oh, yes. We kind of alluded to it last week, and I've got a good few emails and private messages asking me what it was, but I stayed kind of tight-lipped on it.
So I can tell you I don't know how it's in America, right? But it's like an old people's game, what 80-plus-year-old people typically tend to do on, let's say, a Saturday afternoon. And everyone that has, let's say, grandparents or parents at that age probably end up driving them to such a place. And yeah, so do you want to share it, EMF?
Yeah, we're going to have a little game called Dividend Bingo. It's not going to be anything too serious. We'll have a little bit of fun, maybe have a few drinks on air and stuff, but it'll be live. We'll ask questions and we'll have some fun with it. I'm actually quite looking forward to it. We still have to prepare a little bit for it, but we will share on our Twitter, emails, and all our other platforms on, I think it's going to be, 9 o'clock Central European time. And the platform, we're not quite sure. It's probably going to be on YouTube. We just need to sort out the logistics and all that. But look, we hope you join us. It'll be a bit of fun. We'll get to know everyone, meet some new people, chat, and as I said, have a drink or two and enjoy it.
Yeah, I would say just come with your favorite European beer. Take it with you. This is a European dividend show. So I would really love to hear which one it is, which one you're drinking. And, it's just ordinary bingo. It should be fun, beer, and, open to anyone.
Yeah. Look forward to having you there.
Cool. So I think we're at the end of the show again, EMF.
Yeah, man, it goes so fast, doesn't it? Time flies
Yeah.
when you're having fun.
Yeah. So what I'm going to do, I'm going to think about what I will do with my poster of Messi above our bed. No, I'm kidding. But I'm a bit concerned that maybe Barcelona is really getting a bit too old now.
Yeah, they've an Asian team. Look, Liverpool are the team to support. Young team will be back in Europe next year. Okay.
Okay. Hey, thank you all again for listening. I hope that getting a bit more insight in more details than episode 5 about how we do fundamental analysis is helping you. Like EMF said, feel free to reach out. And hope to see you next week. Friday, we'll record the podcast. Saturday, 9 p.m., the Dividend Bingo, 8 p.m. UK time, which is probably 3 p.m. New
New
York
York
time
time.
zone and noon San Francisco time zone. So if you want to join, feel free to keep an eye on us on Twitter, on your emails, and we'll make sure we'll reach out to you somewhere midweek, probably at the last, to provide you the information.
Perfect.
Have a good weekend all. Yeah.
Take it easy. Bye.